Hey guys, I am Deric. Welcome to my channel. In this video, I'm gonna explain to you the financial markets and institutions in Malaysian context. Firms that require funds from external sources can obtain them in the following three ways. Through a bank or other financial institutions. Through financial markets such as stock market or bond market. Through private placements. Let's look at the flow of funds for financial institutions and markets. Here, we have suppliers of funds and demanders of funds. Suppliers are those who have extra money, whilst demanders are those who need money. When you have extra money, the first way, you can consider putting money in the financial institutions, such as banks. Suppliers of funds put money in the financial institutions as deposits. Then, financial institution provides money to the demanders of funds as loans. For such borrowing, demanders of funds will pay back interests to the financial institutions. And financial institutions will pay interest to the suppliers of funds. That's why, when you save money in the bank's deposit account, you will receive interest. That's from the demanders of funds. The second way, if you don't want to deposit your money in the bank, you may consider investing your money in the financial markets, such as share market or bond market. Suppliers of funds provide money to the financial markets through buying shares or bonds, then, the financial markets will transfer the money to the demanders of funds. For receiving the money, the demanders of funds will provide securities to the financial markets. Securities mean the certificate of shares or bonds. And then, financial markets will transfer the securities to the suppliers of funds. That's how we buy shares and bonds in the financial markets. The third way, when suppliers of funds go directly to the demanders of funds, that's when private placement occurs. For receiving money from the suppliers of funds, the demanders will issue securities to the suppliers. The flow of funds may also happen between financial institutions and financial markets. It happens when banks buy shares or bonds from the financial markets. For the financial system structure in Malaysia, the highest authority is the regulatory bodies and policymakers such as Bank Negara Malaysia, Ministry of Finance, and other government agencies. Under financial institutions, there are two divisions. First, banking institutions, which include commercial banks, investment banks, and Islamic banks. Second, non-banking financial intermediaries, which include provident and pension funds, insurance and takaful, saving institutions, and other institutions such as unit trusts, Pilgrims Fund Board, and leasing companies. On the other hand, under financial markets, we have stock exchanges, money and foreign exchange operators, private equities, public debt securities, derivatives, and international offshore financial centers. Now, let's look at the first part, financial institutions. Financial institutions are intermediaries that channel the savings of individuals, businesses, and governments into loans or investments. The key suppliers and demanders of funds are individuals, businesses, and governments. In general, individuals are net suppliers of funds as they are surplus units, while businesses and governments are net demanders of funds in which they are deficit units. The flows of funds start with lenders. When we have extra money, usually we will deposit the money into the savings account of banks. After receiving our money, banks will lend out the money to the borrowers through housing loans or car loans. There are three types of banks in Malaysia, including commercial banks, investment banks, and Islamic banks. Commercial banks are the institutions that provide savers with a secure place to invest their funds and offer loans to individual and business borrowers. Investment banks are institutions that assist companies in raising capital, advise firms on major transactions, such as mergers or financial restructurings, and engage in trading and market-making activities. Islamic banking is also known as Sharia-compliant banking. This type of banking operates according to Islamic principles and law, which prohibits interest, or riba, and other practices considered unethical, such as gambling and speculation. Instead, Islamic banks offer profit-sharing arrangements, or mudarabah, and lease-to-own agreements, or ijara, that comply with Islamic principles. Islamic banking is based on the concept of risk-sharing, where the bank and the customer share the risk and reward of a transaction. During the process of indirect transfer through investment banks, investment bankers who are the intermediaries help firms raise capital by selling securities, such as selling shares. Investment bankers are also known as underwriter or underwriter syndicate. The following are the roles of an underwriter. The underwriter has to ensure that the firm satisfies all regulatory requirements, such as filing with the appropriate bodies and depositing all fees, and makes all mandatory financial data available to the public. The underwriter has to contact large prospective buyers of stock, such as mutual funds and insurance companies, who have large sums of money to invest. The underwriter has to recommend the IPO price to the firm. This is the price at which the shares will be sold. An excessive price may leave the firm with unsold stock, while a price that is too low will mean foregone revenue from the stock sale. The underwriter usually provides a guarantee to the firm to sell a specific quantity of stock during the IPO process. If the underwriter failed to convince prospective investors to buy the shares, the underwriter must buy the surplus shares itself. To avoid having to commit large amount of money to a failed IPO, the underwriter must work especially hard to sell all available shares. After buying the failed IPO from the issuer, the underwriter will sell these shares in the open market. However, the underwriter has to sell it carefully. Because suddenly dumping a lot of shares can drag the price down, hurting both the issuer as well as the underwriter. The underwriter may provide other services such as professional advices on matters related to corporate restructuring, M&A, LBO, and so on. The next part is financial markets. Financial markets refer to the marketplace where the trading of securities occurs, including the stock market, bond market, forex market, and derivatives market. It can be classified as primary market or secondary market according to originality of issues. Or it can be classified as money market or capital market according to maturity period. Let's make a comparison between primary market and secondary market. Whether subsequently traded in the money or capital market, securities are first issued through the primary market to collect funds from the fund providers. This is the only market in which the issuer is directly involved in the transaction, and the only time the issuing firm receives cash inflow from the securities. Once issued, securities are then traded on the secondary markets, such as KLSE Bursa Malaysia Stock Exchange. Issuing firm does not receive any cash inflow. Prices of securities are determined by the demand and supply in the market. The secondary market is important to the primary market, as it provides liquidity and guideline in pricing the new issues in primary market. Money market versus capital market. The money market is created by a financial relationship between suppliers and demanders of short-term funds, with the maturity periods of 1 year or less. Most money market transactions are made in marketable securities, which are short-term debt instruments, such as treasury bills, which issued by government, certificate of deposits, which issued by commercial bank, commercial paper, which issued by large corporations, and banker's acceptance, which is the bank draft issued by firms. Investors generally consider marketable securities as the least risky investments. Whilst the capital market is a market that enables suppliers and demanders of long-term funds to make transactions, in which the maturity is greater than 1 year. The key capital market securities include bonds and both common and preferred stock. Bonds are long-term debt instruments used by businesses and government to raise large sums of money, generally from a diverse group of lenders, such as T-bonds, corporate bonds, and mortgages. Common stock represents units of ownership interest or equity in a corporation. Preferred stock is a special form of ownership that has features of both a bond and common stock. The capital market of Malaysia is governed by the following acts of Parliament, including Capital Markets and Services Act 2007, Securities Industry Central Depositories Act 1991, Securities Commission Act 1993, Companies Act 1965, Offshore Companies Act 1990, and Labuan Financial Services and Securities Act 2010. The capital markets play an important role in the financial market. First, From a firm's perspective, the role of capital markets is to be a liquid market, where firms can interact with investors in order to obtain valuable external financing resources. Second, from investors' perspectives, the role of capital markets is to be an efficient market that allocates funds to their most productive uses. Simply speaking, capital markets allow suppliers and demanders of funds to get what they want. Next, let's compare the differences between public offering and private placement. First, about public offerings. This is the sale of securities openly to the public. Everyone can buy public offerings. This is an impersonal market, in which there is no direct contact with investor. To protect the investors, Securities Commission (SC) registration is required. Second, about private placement. This is the sale of securities privately to a limited number of investors. Not everyone can buy. It involves face-to-face negotiations about the selling and buying price. As this is a private contract, SC registration is not required. As such, most firms raise money through a public offering of securities, which is the sale of either bonds or stocks to the general public. Next, let's compare the differences between organized security exchanges and over-the-counter markets. First, about the organized security exchanges. These are the marketplaces for trading listed securities. Companies must meet exchange listing requirements set by Securities Commission. Usually, securities are traded on a centralized exchange, as it provides a physical location for its members to trade. However, the security exchanges are not involved in the trading of securities and the setting of security price. The prices are set by the demand and supply of the market. Next, about the over-the-counter (OTC) markets, aka dealer markets. These are the marketplaces for trading unlisted securities. Typically for smaller companies that cannot meet exchange listing requirements of formal exchanges. Usually, securities are traded via a broker-dealer network, and dealers post bid and ask price to make a market. The difference between bid and ask price is the spread, which means if the ask price is greater than the bid price, they will make a profit. Bank Negara Malaysia, or Central Bank of Malaysia, plays an important role in maintaining financial stability. Financial stability is a state in which the financial system, that is the key financial markets and the financial institutional system, is resistant to economic shocks, and is fit to smoothly fulfill its basic functions, such as the intermediation of financial funds, management of risks, and the arrangement of payments. This is primarily achieved through the regulation and supervision of licensed financial institutions by the central bank. A key priority for the central bank is to maintain a robust, effective, and efficient regulatory framework, which is responsive to changing economic conditions, in maintaining the resilience of financial institutions, while providing an environment conducive for financial innovation and growth. The responsibilities of the respective supervision departments are as follows. First, financial conglomerates supervision, which involves the supervision of domestic financial conglomerates. Second, banking supervision, which involves the supervision of foreign banks, standalone investment banks, and all Islamic banks, including Islamic banking subsidiaries of domestic banks. Third, insurance and takaful supervision, which involves the supervision of insurance companies, reinsurance companies, takaful operators, retakaful operators, as well as international takaful operators. Securities Commission (SC) is another important government agency of regulating the capital markets in Malaysia. SC is a statutory body, entrusted with the responsibility of regulating and systematically developing the capital markets in Malaysia. SC was established on March 1, 1993, under the Securities Commission Act 1993. It is a self-funding statutory body with investigative and enforcement powers. SC reports to the Minister of Finance, and its accounts are tabled in Parliament annually. SC has the power to investigate and enforce the areas within its jurisdiction. About the functions of SC Malaysia, these includes: first, supervising exchanges, clearing houses and central depositories. Second, registering authority for prospectuses of corporations other than unlisted recreational clubs. Third, approving authority for corporate bond issues. Fourth, regulating all matters relating to securities and futures contracts. Fifth, regulating the takeover and mergers of companies. Sixth, regulating all matters relating to unit trust schemes. Seventh, licensing and supervising all licensed persons. Eighth, encouraging self-regulation. And the last one, ensuring proper conduct of market institutions and licensed persons. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.